Hello class, today we're doing chapter 8 personal finance, section 8.8 credit cards, and we're going to wrap up chapter 8 with credit cards. So our objectives today are to find the interest, the balance due, and the minimum monthly payment for credit card loans, understand the pros and cons of using credit cards, understand the difference between credit cards and debit cards, know what is contained in a credit report, understand credit scores as measures of credit worthiness, and recognize factors that affect credit scores. Now, let's look at open-ended installment loans. So using a credit card is an example of an open-end installment loan, commonly called revolving credit. Open-end loans differ from fixed installment loans such as car loans and mortgages in that there is no schedule for paying a fixed amount each period. Credit card loans require users to make only a minimum monthly payment that depends on the unpaid balance and interest rate. Now, most credit card customers are billed every month. The typical billing period is May 1st through May 31st, but it can also run from, say, May 5th through June 4th. Customers receive a statement called an itemized billing that includes the unpaid balance on the first day of the billing period, the total balance owed on the last day of the billing period, a list of purchases and cash advances made during the billing period, any finance charges or other fees incurred, the date of the last day of the billing period, the payment due date, and the minimum payment required. Customers who make a purchase during the billing period and pay the entire amount of the purchase by the payment due date are not charged interest. Now, let's look at interest on credit cards, the average daily balance method. So interest is calculated using I equals PRT, where R is the monthly rate and T is 1 month. The principal P is the average daily balance. The average daily balance is the sum of the unpaid balances for each day in the billing period divided by the number of days in the billing period. The average daily balance is the sum of the unpaid balances for each day in the billing period over the number of days in the billing period. So, the issuer of a particular Visa card calculates interest using the average daily balance method. The monthly interest rate is 1.3% of the average daily balance. The following transactions occurred during the May 1st to May 31st billing period. So, let's look at this transaction report right here. We've got the transaction description. So, our previous balance was $1,350. May 1st was our billing date. On May 8th, we made a payment. So, we got a $250 payment that we made towards our credit. Now, on May 10th, there was a charge for airline tickets for $375. On May 20th, we had a charge for books of $57.50. On May 28th, we had a charge for a restaurant where we spent $65.30. And on May 31st, the end of the billing period, we had no transaction that happened upon that day. That was just the day that the billing period ended. Now, our payment due date is June 9th. All right. We want to find the average daily balance for the billing period, rounded to the nearest cent. We want to find the interest to be paid on June 1st, the next billing date, and round to the nearest cent. We want to find the balance due on June 1st. And also, this credit card requires a $10 minimum monthly payment if the balance due at the end of the billing period is less than $360. Otherwise, the minimum monthly payment is 1/36 of the balance due at the end of the billing period, rounded up to the nearest whole dollar. What is the minimum monthly payment due by June 9th? All right, let's track through here. Take a deep breath. Pause if you need to. When you watch these lectures, I hope that you're pausing multiple times to kind of read through the question and make sense of it on your own. I don't expect you to watch this all the way through, one time through, with no pauses and to get everything. That's just unrealistic. This is meant to be paused and worked through on your own as we work through it. If you watched it all the way through all at one time, it would go incredibly fast, and it would be very difficult to learn. So please take your time, pause through it, work through it, read through it, and make it make sense. All right, so we're going to begin by finding the average daily balance for the billing period. First, make a table that shows the beginning date of the billing period, each transaction date, and the unpaid balance for each date. Okay, so on May 1st, we had an unpaid balance from the previous month of $1,350. Okay, now on May 8th, we paid that $250 to try to pay some of that debt down. So doing so caused us to pay our debt down to $1,100. Okay, then on May 10th, we wound up spending that $375 on airfare, which brought our debt back up to $1,475. Then we went out to eat, I believe, on May 20th. So that made our debt go. Or did we go out to eat? No, we bought books. Sorry, we bought books on May 20th. My bad. And that caused our debt to go up to $1,532.50. And then we went out to eat on May 28th, adding another $65.30, causing our debt to now go up to $1,597.80. Okay, so let's look at this. So we're going to now extend our table by adding two more columns. One column shows the number of days at each unpaid balance. The final column shows each unpaid balance multiplied by the number of days that the balance is outstanding. All right, so the first added column is the number of days at each unpaid balance. Okay, so our start date was May 1st. We went to May 8th before we spent or charged or paid back any money. Okay, so the difference between May 8th and May 1st was 7 days. That's where the 7 comes from. The difference between this date and this date was 7, and that's where this 7 comes from. The difference between this date and this date, May 8th and May 10th, is where the 2 comes from. The difference between May 10th and May 20th is 10, and that's where that 10 comes from. And the difference between May 20th and May 28th is 8. And you're like, where did this 4 come from? Well, this 4 came because there are 31 days in May overall. And this is a monthly thing. Our monthly range goes from May 1st to May 31st. So the difference between May 31st and May 28th, May 31st is the last billing day. Difference between May 31st and May 28th is 4. That's where that final 4 came from. Okay, so everybody should know where the number of days that each unpaid balance came from. Okay, so 7, 2, 10, 8, and then like I said, that final 4 came from right there. All right, now what we want to do is multiply our unpaid balance times our number of days here. So I've got the 1,350 times the 7 is going to give me $9,450. All right, the 1,100. We're going to multiply that times the 2, give you 2,200, and we're going to continue this trend multiplying all these numbers, okay, column at a time. Then we're going to total it. This totals, if we take all those numbers we just multiplied, take your time doing them. Like I said, please pause if you need to because you want to work through this on your own. But if we total all those numbers together in this column, after we multiply them, we total them all down by adding them, we get $45,051.20, okay? This is the sum of the unpaid balances for each day in the billing period. Now, don't freak out. We don't owe $45,000. Don't freak out. This is just the total of the number owed each day. Now, what we're going to do is find the average, okay? So we're going to divide that by 31 because 31 days in May, right? We've discussed that already. 31 days in May, that's the total number of days for our billing period. We're going to take that $45,051.20, divide it by 31, and we're going to see that our average debt owed per day is $1,453.26. So that's all that this description is saying. Divide the sum of the unpaid balances for each day in the billing period, the $45,051.20, by the number of days in the billing period, 31, gives us the average balance. Okay, average daily balance. Now, the reason we want to find that is we want to take that number, multiply it by our interest rate, and figure out how much we owe. Okay, so the interest rate here is 1.3%. Okay, so I equals PRT. So We're going to take the $1,453.20, which is our average amount that we had of debt per day in that month. We're going to multiply it by our interest rate, which is 1.3%, or convert it to a decimal, 0.013. We're going to multiply it times 1 because we're looking at our 1 month here. Okay. Now that gives us approximately $18.89 in interest. Okay. So the balance due on June 1st is the unpaid balance on May 31st plus the interest over the month. Okay. So the unpaid balance on May 31st, if we look at it, is $1,597 back on our previous chart here. This is the amount that was due, or that we had on May 31st. Now, we didn't add any more charges till after May 28th. That's why it's the same value for May 31st. Right there. Okay. So that's where that number comes from. All right, skip all the way down here. That's where this comes from. This is our last balance amount for that month. We're going to add that interest we just calculated in part B here. Okay. We add that $1,889 to that $1,597.80, and we see at the end of this month, our balance due on that June 1st, that next month, is $1,616.69. Now, because the balance due of $1,616.69 exceeds the $360, now you're okay, where'd the $360 come from? Okay, flip back in your notes, and it says right here on Part D, if the balance is less than $360, then we only owe a $10 payment per month. Otherwise, the minimum monthly payment is 1/36th of the balance due at the end of the billing period, round to the nearest dollar. So because we're not less than $360, we got to take 1/36th of what we owe, and that is going to be our payment for the month, rounded to the nearest dollar. So this is what we owed at the end of the month, the $1,616.69. We need to pay a minimum of 1/36th of that. So essentially, we just need to divide that by 36, which is what we're doing. So $1,616.69, we divide it by 36, round it up to the nearest dollar. We're paying $45 that month for our credit card payment. Now, keep in mind that your minimum monthly payments aren't going to pay your credit card off in a decent manner. They're just going to allow you to continue using the credit card. My advice, always pay more than the minimum payment, because if you just pay the minimum payment per month, you're not going to get anywhere at all. At all. Anyway, so matter of fact, let's see if I can show this to you. Did we calculate that? I believe we did. Yeah, so the interest, let's see. Yeah, so the interest that we paid was $18.89 on that money. And that was a very, very low interest rate, by the way. 1.3% is very low. You'd be surprised if you find that on a credit card. Most are over 10%. Most are like 12%. And some go up to like 20-something percent. So that was a very low interest rate. And even with that very low interest rate, we were paying basically $19 a month in interest. And at the end of that month, when we make that $45 payment, that $45 payment is going to have about $20 taken out of it for interest. So you're really only paying $25 towards that overall total to bring it down. So you're not making much of an impact to your debt there. It'd take you a long time to pay that off. So let's take a step back, though, and let's look at our steps for determining the average daily balance. The first thing we did, step 1, we make a table that shows the beginning date of the billing period, each transaction date, and the unpaid balance of or for each date. Step 2, we add a column to the table that shows the number of days at each unpaid balance. Step 3, we add a final column to the table that shows each unpaid balance multiplied by the number of days that the balance is outstanding. Step 4, we find the sum of the products in the final column of the table. This dollar amount is the sum of the unpaid balances for each day in the billing period. And step 5, we compute the average daily balance. The average daily balance being the sum of the unpaid balances for each day in the billing period over the number of days in the billing period. Now, let's look at some advantages of credit cards. Okay. One advantage of a credit card is you get to use a product before actually paying for it. Now let's think about this. Just because you pay for it with a credit card doesn't mean you paid for it. Technically, the person or the entity over the credit card is paying for it. You have to pay them for what you just bought. So technically, you don't own it. They do, right? But you get to use it because you bought it with their credit card. Anyway, no interest charges by paying the balance due at the end of each billing period. So as long as you pay the balance due at the end of each billing period, you don't have to pay interest, which is a great asset of credit cards if you responsibly use them. Which brings us to the next point. Responsible use and an effective way to build a good credit score. Okay. Now you can see page 581 of your textbook for a discussion of good credit scores. I'd highly recommend doing that. It's always good to have a good credit score. There's no need to carry around large amounts of cash. It's more convenient to use than checks. I mean, who even uses checks anymore, right? Checks are still around, but not many people use them. Offer consumer protections if there is a disputed or fraudulent charge on your credit card statement. Let the card issuer know, and the amount is generally removed. Not always, but generally so, especially if you have a good credit agency and it's not something that happens to you all the time, right? So I've personally never had any issues with my credit card company that I use removing anything that was fraudulent, because it does happen from time to time. But they're usually really, really good about removing that charge so that you don't have to pay it because you did not do it. Provides a source of temporary emergency funds. It's probably what I use mine for the most, emergency funds. It extends shopping opportunities to purchases over the phone or the internet. Okay, because of the fraud protection on the credit cards, it is a valued tool for purchasing stuff on the internet. That might not necessarily be covered if you get your debit card fraudulently used, depending on your agency and bank that you might use your debit card through, but credit cards usually have that covered. Now, simple tasks like renting a car or booking a hotel room can be difficult or impossible without a credit card. Monthly statements can help keep track of spending. Some card issuers provide an annual statement that aids in tax preparation. It may provide amenities such as free miles towards air travel, and it's useful as identification when multiple pieces of identification are needed. But obviously, if there are advantages, there could indeed be some woes. So let's look at the credit card woes. High interest rates on unpaid balances. Now, that's what I was telling you. The credit card example we looked at had an extremely low interest rate. But in 2009, interest rates were as high as 30% on credit cards. Not 1.3, 30%. And at 30% interest, that interest is going to hike your debt up fast if you do not pay it down. There's no cap on interest rates. In 2009, the U.S. Senate defeated an amendment that would have imposed a 15% cap on credit card interest rates. The Credit Card Act passed by Congress in 2009 does restrict when issuers can raise rates on existing unpaid balances. Your initial credit card interest rate is unlikely to go down, but it sure can go up. Thanks, Congress. Anyways, there's no cap on fees, according to Consumer Reports of October 2008, cited a credit card with an enticing 9.9% annual interest rate. But the fine print revealed a $29 account setup fee, a $95 program fee, a $48 annual fee, and a $7 monthly servicing fee. Nearly 40% of the $40 billion in profits that U.S. credit card or U.S. card issuers earned in 2008 came from fees. Furthermore, issuers can hike fees at any time for any reason. Read the fine print of a credit card agreement before you sign up. Please, please, please read the fine print. Know what you're signing, know what you're getting into. Because when you go in there to get it, they will slip some stuff in the fine print if you're not careful. And they will smile at you while they do it. So please protect yourself. Know what you're getting yourself into. Read the fine print. Ask additionally about setup fees and all these other fees that they could slide in. Go with a reputable bank or credit union. I use a credit union personally. But please be careful. Okay. More woes. It's easy to overspend. Purchases with credit cards can create the illusion that you're not actually spending money, but trust me, you are. It can serve as a tool for financial trouble. Using a credit card to buy more than you can afford and failing to pay the bill in full in each month can result in serious debt. Fees and interest charges are added to the balance, which continues to grow even if there are no new purchases. So, those fees are going to keep coming. Those interest charges are going to keep coming unless you pay it off or pay it significantly down. The minimum payment trap. Credit card debt is made worse by paying only the required minimum. A mistake made by 11% of credit card debtors. Pay the minimum and most of it goes towards interest charges, and you're not actually paying your debt down. If you pay the minimum, I'm not going to say you'll never pay your card off, but paying the minimum is not a way to get rid of your debt. Now, let's look on the other hand at debit cards. Debit cards offer the convenience of making purchases with a piece of plastic without the temptation or ability to run up credit card debt. You can't spend money you don't have because the card won't work if the money isn't in your checking or savings account. Now, a little caveat to that last piece. You technically can spend more money than you have, but if you do, your bank's going to charge you. So if it does happen to slide and go through, some banks do tie in fees and stuff for overdrafting. You got overdraft fees, and some of them will even if it rejects it or whatever when you slide your card, some of them will even hit you a fee for that, insufficient fund fee. So please be careful of that as well. Don't swipe it if you ain't got it. Now, debit cards have drawbacks. They might not offer protection a credit card does for disputed purchases. Kind of said that earlier. It's easy to rack up overdraft charges. Was just talking about that. If your bank enrolls you in an overdraft protection program. This means that your card won't be turned down if you do not have sufficient funds in your account to cover your purchases. You'll be spared the embarrassment of having your card rejected, but it will cost you fees of approximately $27 per overdraft. Oof. Debit card purchases should be treated like those for which you use a check. Record all transactions and their amounts in your checkbook, including any cash received from an ATM. Always keep track of how much money is available in your account. Your balance can be checked at an ATM or online. So let's look at credit reports and credit scores. As a college student, it is unlikely that you have a credit history, but maybe you do. I got my first credit card when I was 15. Once you apply for your first credit card, your personal credit report will begin. A credit report contains the following information. Identifying information. This includes your name, social security number, current address, and previous addresses. A record of credit accounts. This includes details about all open or closed credit accounts, such as when each account was opened, the latest balance, and the payment history. Public record information. Any of your public records, such as bankruptcy information, appears in this section of the credit report. Collection agency account information. Unpaid accounts are turned over to collection agencies. Information about such actions appear in this section of your credit report. And also inquiries. Companies that have asked for your credit information because you applied for credit are listed here. You don't want too many inquiries. Okay, so this is where you have to be careful too. I don't know if we'll discuss this further, but inquiries can hurt your credit report, especially if you have like a company that does inquire and then you don't make the purchase. So inquiries, especially hard pull inquiries and stuff, like if you get one, you're looking to buy a house and they pull your credit and then you don't buy the house, that could hurt you. It could hurt your credit score, so to speak. It will eventually come back up, but it could hurt it. Same thing with buying a car. They could pull your credit at the dealership to make sure that your credit's good enough to buy the car if you're financing. And if you don't want to go, pulling your credit on your car too many times and then not buying. It can affect your credit. There's a lot of things that can affect your credit. All right. Organizations known as credit bureaus collect credit information on individual consumers and provide credit reports to potential lenders, employers, and others upon request. The three main credit bureaus are Equifax, Experian, and TransUnion. You can get your credit report from the three bureaus free at annualcreditreport.com. But don't go checking your credit if you don't need to. Once again, even when you check your own credit, it's recorded as an inquiry, and that's not necessarily a good thing. So you don't want to go pull your credit every day and look at it. It's not going to change like that anyway. All right. Credit bureaus use data from your credit report to create a credit score, which is used to measure your credit worthiness. Credit scores or FICO scores range from 300 to 850, with a higher score indicating a better credit. This table contains ranges of credit scores and their measures of credit worthiness. So let's look at scores. Scores from 720 to 850 are very good to excellent, and you tend to get the best interest rates on loans if you have a score of 720 to 850. Now, 650 to 719 is good and most likely to get credit, but not the best interest rate on loans compared to a higher score. 630 to 649 is fair. You might get credit, but you might have it at a higher rate. 580 to 629 is poor and could be and likely to be denied by credit for all but high interest lenders. And 300 to 579 is bad, and you're really, really likely to be denied any kind of credit at that low of a score. And even if you are denied credit or are given credit at a low score like that, you're probably going to have a astronomically high rate that you're going to have to pay. Now, factors that affect credit scores. Let's look at this. The payment history. Late and missing payments show up on your credit report and can lower your score. For a higher credit score, be sure to make your payments by the due dates. So, don't want any late or missing payments. Account balances. High account balances may lower your score, especially when the balances are close to your credit limits. Keep any credit card balances well below the credit limits on the cards. Length of credit history. In general, the longer you've had credit, the higher your score will be. Unless, obviously, you've ruined it. Okay. Credit mix. For a higher score, it is good to have a mix of types of credit, such as credit cards, car loans, and mortgages. That will help build your credit. New credit. Opening multiple new accounts in a short period of time is viewed as risky and may lower your score. Now, this concludes Chapter 8.8 and Chapter 8 altogether. Please go on and complete the associated assignments. If you have any questions whatsoever, please don't hesitate to reach out by email. Y'all have a good one, and I will see y'all next time.